Welcome to Talk Tickers. You're tuning in for a breakdown of what truly matters from the latest earnings calls.
And today, we are definitely diving straight into the Sirius XM first quarter 2025 earnings call.
Yeah, think of this as your shortcut, really, to understanding the key takeaways. Let's get into the numbers first.
Okay, so the first quarter was, well, a bit of a mixed bag for Sirius XM. We saw total revenue land at $2.07 billion. That's actually a 4% decrease year over year.
Right, and they put that down to subscriber dips and softer ads.
Exactly. Modest subscriber declines, softer advertising trends. That was the reason given. Net income came in at $24 million.
Okay.
And adjusted EBITDA, that was $629 million. So down about 3% from last year.
But the margins were consistent, I saw, around 30%.
Yeah, margins held steady at 30%. Free cash flow, though, took a bit more of a hit.
How much?
It landed at $56 million. That's down from $88 million in the prior year. Mostly timing on payments, some lower cash receipts, higher CapEx, though they did save on those Liberty deal costs.
Gotcha. But there was some good news on the subscriber front, right? Losses weren't as bad.
That's right. The self-pay net subscriber losses actually improved year over year. Came in at a 33,000 lost, which is a 16% improvement.
Okay. And churn?
Churn also looked better, down 18 basis points, reaching 1.6%.
So despite some of those, dips in revenue and cash flow, they're sticking to their guns on the full year.
They are. Reaffirmed the full year 2025 guidance. That's approximately $8.5 billion in revenue, $2.6 billion adjusted EBITDA, and $1.15 billion in free cash flow. So, yeah, signaling continued confidence there.
Okay, let's really dig into that subscription business then. It sounds like there were some interesting dynamics at play.
Absolutely. What's particularly noteworthy is the strength they saw in their core in-car subscription business.
Right.
That performance actually managed to offset an expected, reduction in their streaming net additions.
Okay, and the churn piece is fascinating, especially with the price increase.
It really is. The in-car churn actually went down. And this was despite them rolling out a full price rate increase back in early March.
So people didn't balk at the higher price?
Apparently not much, no. They reported minimal negative impact from that price hike so far. And get this, they actually reported their highest quarterly customer satisfaction on record.
Wow. Okay. That suggests some real loyalty or value perception, I guess.
Yeah, real stickiness with that core in-car offering. They think the added value they pushed out last fall helped cushion the blow from the price increase.
Makes sense. What else are they doing in a car?
Well, they're actively working on refining the pricing and packaging, trying to rely less on those deep promotional discounts, make things a bit more transparent. And we're seeing new programs have an impact too. Things like enhancements for Tesla used car owners.
Ah, the used car market. Important.
Very. And also expanding those multi-year OEM subscriptions. They mentioned Ford and Lincoln are coming on board late next year for the 2026 models.
So these seem to be helping with acquiring new in-car subs.
Seems like it, yeah. Better in-car acquisition was definitely mentioned as a positive driver.
And the big one, everyone's watching this ad-supported tier. What's the latest thinking there?
Right. So this is a really strategic expansion. They're targeting a huge potential audience, something like nearly 100 million existing cars out there, plus the new car trials.
And the idea is just to add an advertising revenue stream without messing up the premium tiers.
Exactly. Launch an ad-supported option, just a subset of the music and talk content, and leverage the advertising business without, risking cannibalizing the premium and free subs. Testing is apparently starting soon.
And the tech rollout helps here too, right? The 360L platform.
Definitely. They expect over half of the new Sirius XM equipped cars this year will have 360L. That platform integrates satellite and streaming, allows for much more personalized content, and crucially, better ad targeting.
So richer data, potentially better ad revenue from this new tier.
That's the plan. It could be really key for making that ad-supported tier work well.
Okay, let's switch gears to advertising overall. How did that side of the business perform in Q1?
So overall ad revenue was pretty much flat year over year, relatively stable.
But podcasting was a bright spot.
Huge bright spot. Podcasting revenue saw a really significant jump, 33% year over year.
Wow.
Yeah. They're now at 70 million monthly listeners, nearly 1 billion downloads just in Q1.
That's massive scale.
It is.
Yeah.
And they've also launched this Creator Connect solution. It's designed to, link marketers directly with creator audiences across audio, video, social.
Kind of like an influencer marketplace, but for audio focus?
Sort of, yeah.
Yeah.
And they said bookings for the social and video parts of that already beat all of last year's numbers. So early traction seems strong.
And they have the Pandora experience to lean on here too.
Exactly. They know how to monetize ad-supported digital music from Pandora, so that gives them a solid foundation as they try to grow advertising across Sirius XM more broadly.
Did they mention any specific advertising sectors being particularly strong or weak?
They did. They saw some softness in travel, auto, and retail.
The usual suspects in a potentially slowing economy.
Could be. Might signal shifts in consumer confidence, maybe a move towards more short-term, performance-driven marketing instead of big brand campaigns.
But some areas were strong.
Yeah, pharma and telco advertising were called out as areas of strength.
Okay. And they're investing in ad tech too.
Continuously, making it easier to buy, plan, measure campaigns across broadcast, streaming, podcasts, the whole ecosystem.
Makes sense. Okay, let's talk costs. Sounds like efficiency is a big theme.
It really is. They're definitely focused on it. They reiterated they're on track for that $200 million in run rate cost savings by the end of this year.
And they've started seeing results already.
Yep, over $30 million already realized just in Q1.
Where are the savings coming from?
Pretty broad-based, actually. Marketing expenses were down 19%, mainly from streamlining the media mix. Product and tech down 15%. Also savings in transmission, customer service, G&A, kind of across the board.
And AI, is that part of the cost-saving plan?
They're exploring it, yeah. Looking at AI applications to improve customer experience, make marketing smarter, optimize the ads business. All the usual places you'd expect.
Right. Now, given all the talk about the economy, tariffs, car sales, how does SiriusXM see those impacting things?
Interestingly, management sounded pretty sanguine about tariffs. They don't expect a significant material impact on subscriber results this year.
Why not? Wouldn't tariffs on cars hurt them?
Well, their logic is based on a few things. One, the recurring revenue model gives them some insulation. Two, their growing penetration in the used car market helps offset new car issues.
Ah, right, the used car angle again.
Exactly. And they say they're getting better at capturing trials and converting them. Plus, their direct tariff exposure on costs is minimal because they don't make the hardware themselves.
So indirect exposure through automakers is negligible for now.
Seems to be, yeah. They're watching consumer health and spending, of course. But the strong churn performance so far suggests consumer behavior hasn't really shifted dramatically for their service.
And they figure if new car sales slow, used car sales might pick up some slack.
That's the hope, or at least the potential offset. They feel they're well positioned there and improving their trial game with data partnerships. Plus, ironically, fewer new car sales might mean less vehicle-related churn in the near term, people keeping cars longer.
Okay, so that helps explain why they're sticking with the full year guidance despite some of these, headwinds.
Right. The guidance reflects their view on subs, revenue, and those cost savings kicking in. They expect cost improvements to continue, hitting that $200 million run rate by year end.
But they might reinvest some savings?
Potentially, yeah. They flag that some of the Q1 sales and marketing savings might get redeployed later in the year, possibly linked to launching that new ad-supported tier.
Got it. Now, they did mention click-to-cancel having an impact.
Yes, they did. As they roll that out across the U.S., they expect it will have an incremental negative impact on churn this year.
Okay.
That, combined with pulling back on some streaming-only marketing and maybe some effects from shorter promo plans, is expected to lead to, they said, a couple 100,000 incremental negative net ads for the full year.
But the core in-car business net ads should improve.
That's the expectation, yes.
Yeah.
Underlying in-car net additions are projected to be better year over year.
Okay. And ARPU, average revenue per user.
The ARPU was $14.86 in Q1. That was down 3% year over year.
Ouch.
Yeah, but they expect the comparisons to get more favorable as the year goes on. On the other side of the coin, subscriber acquisition costs, or SAC, actually went up.
Why was that?
Mainly due to some contractual changes with automakers and also higher chipset costs.
Right. Let's circle back quickly to the pricing strategy. We touched on the March increase having minimal impact. What's the general approach going forward?
So the general philosophy seems to be aiming for price increases roughly every other year, kind of a cadence. But they'll look at it every year, evaluate specific packages, consider the economy, the whole range of options they have now. It gives them more flexibility than just one big price hike across the board.
Makes sense. And finally, capital allocation. What are the priorities?
Well, in Q1, they returned $116 million to stockholders. That was through dividends and some share buybacks.
Okay.
They ended the quarter with their leverage ratio, net debt to adjusted EBITDA, at about 3.8 times. Their long-term target is lower, down in the low to mid 3x range.
So deleveraging is still a goal.
It seems to be, yeah.
Yeah.
They emphasize a balanced approach, wanting financial flexibility, but also consistent capital deployment back to shareholders.
Okay, let's shift to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea.
All right, let's hear it.
So how about this? Consider a pairs trade. You go long off a basket of companies that are heavily reliant on new auto sales. Think certain auto parts suppliers with big OEM exposure.
Okay, and the short side.
And you short Sirius XM.
Interesting. What's the thesis? Contrarian to management's confidence.
Exactly. The idea is, while management sounds confident about weathering potential new car sales drops because of used cars and loyalty, a really significant sustained downturn in new vehicles could eventually start to pressure their subscriber growth, even if they're resilient near term.
So the long side bets on a rebound or continued strength in new cars.
Right, capitalizing on that. While the short on SiriusXM acts as a hedge, betting that a deeper economic slowdown hitting the auto sector hard might eventually impact SiriusXM's future acquisition pipeline more than they currently expect.
So you're betting on a divergence between the direct auto suppliers and SiriusXM, despite the latter's optimism.
Yeah, it's definitely a contrarian view compared to what we just heard on the call. But, thought experiment territory. Remember, this is absolutely not investment advice, just kicking ideas around.
Got it. A provocative one. Okay, so that wraps up our deep dive into the SiriusXM first quarter 2025 earnings call. We've hit the key results, the strategies, what it might mean going forward.
Yeah, lots to think about. What are your thoughts out there? Do you buy into SiriusXM's focus on the in-car experience as the main anchor? Or is the digital and advertising expansion more critical?
And that ad-supported tier game changer, or just another option?
Yeah.
Lots of moving parts.
Definitely. As always, we strongly encourage you to do your own homework, dig into the details, and form your own conclusions.
Absolutely. Thanks for tuning in.
Join us next time on Talk Tickers as we unpack another critical earnings call and bring you the insights that matter.